How many people have now left the workforce permanently? And what does that mean for the Fed and for the markets? Joining me now is Bill Rogers. He's vice president at the Federal Reserve Bank of St. Louis. He's also a former chief economist for the U.S. Department of Labor. Bill, it's great to see you again. How many of these dropouts are permanent, do you think?
Well, we don't know that just yet, right? Because this comes from the monthly household survey, and people are asked, are they working? If they're working, how many hours they're working. But in this case, people are asked, are you working? And they're saying, no, I'm not working. And if it's even going a step further, they're saying that I'm, I don't want a job. But that could change, right? I mean, we've been studying this group of men and women, 55 to 64 years of age, and about a third of them seem to have a college degree, or at least a college degree. So one possible story that people have been telling, which could be again more permanent, is that these are people who have 401ks, who got good settlements coming out of leaving their firms, and even though they're retiring early or leaving the labor market early, they have the income that they could make it permanent. But I'm still reticent to say it's permanent just yet.
Well, I think the reason why this is so important is, let's say we're down 4 or 5 million jobs from pre-pandemic, and 3 million of those are early retires, for example. We just heard from Chair Powell this week, who kept saying they want to make sure that they are supporting the recovery until the labor market fully recovers. Well, I mean, are we getting pretty close now, right? Or are we waiting for the labor force to re-expand or not?
Well, the groups that I focus on in my staff at the Institute for Economic Equity, we're actively monitoring those individuals who many people will call vulnerable groups. These are individuals who, during bad times, they're the first people to lose their jobs. During good times, they're sometimes the last to benefit. And who are some of those groups? It's women, it's minorities, it's people with disabilities, it's people with no more than a high school degree. And when you look at their participation rates, we still have a long way to go in terms of being able to provide opportunities. So I'm hopeful that we can solve some of the issues around supply constraints, and that we'll continue to see compensation efforts to attract and retain employees to continue, but also see employers change their mindset. Because typically in previous expansions like this, you get not only increases in compensation, but you also get employers changing their attitudes or their perceptions or their views about who's employable, such as hiring young, less educated workers or people who are formerly incarcerated, nonviolent drug offenders. And so that's what we're looking for and trying to see. And once we see more and more of those kind of individuals pulled into the labor market, then I'll start to say, yeah, we're at full employment.
Well, I think the reason,
really close.
Ordinarily, we would all say, of course, you want to cast, as wide, get that tent as big as possible. Absolutely. No question. Everybody would want that. But to paraphrase what Steve Leisman asked the chair earlier this week, he said, is there a welfare trade-off, an overall consumer welfare trade-off between the swaths of Americans who are paying higher prices, which you could trace back to the Fed, and those who are still waiting to be absorbed into the labor force? It's not. Is there a give and take, in other words, in waiting for employment to expand to the final possible parts of the population? Is the rest of the population paying much higher prices for food and energy and all the rest of it?
Yeah, well, my reading of the data is that that thus far, the inflationary pressures we've been seeing, are coming from the production side, such as the challenges of the supply bottlenecks, and as the director of the Institute for Economic Equity, myself and my staff, we are really focused on finding those opportunities for that young, less educated non-high school graduate, or for that young college graduate, and to get a toehold in the economy, because there's been a great deal of evidence that has shown cohorts or particularly young groups who enter during recessions, it can take up to a decade for them to catch up in terms of their earnings, or they also sometimes will experience lower lifetime earnings.
Yeah.
Lowell Ricketts and Anna Kent and Ray Bashar, 3 colleagues of mine, at our institute that are doing work on issues of wealth, and they've shown dramatic differences by cohort. And so it's a benefit cost analysis. Yes, there are costs, but the benefits, in my view, as the director and what we're working on, the benefits of the groups I've talked about getting toeholds into the economy, they're going to be consuming, they'll be producing, they're going to be productive, and hence going to be adding to economic growth.
Shepard Smith here. Thanks for watching CNBC on YouTube.